Even the least experienced stock market investor has probably heard the term buy low, sell high. If you can find something that is incorrectly valued by the market and the market eventually recognizes what you see in that company or that stock or that asset, you can make a good amount of money. But this is actually quite difficult to do. You're going against a lot of combined wisdom when you're going against the market. That doesn't mean you can't be right, but it does mean you have to do a lot of extra diligence to make sure that you have a theory that you feel you can prove and test against real-world experience. This concept overall is called contrarian investing. And I asked my colleague Sam Taube to come and help us understand kind of some of the principles of what you need to do in your contrarian investing and some of the ways to test yourself to make sure you're making a decision that you feel good about. Now, before we get started, I want to tell you that Sam and I are not financial advisors. This is not personalized financial advice, but these are some general ideas that can help you navigate the question of how to do contrarian investing, when you're doing it, and when you're doing it with the most prudent approach possible. Sam, in general, the stock market, if you look at it broadly, has returned pretty well for people who have bought, broad, diversified portfolios. Why would you want to try to go against that? What's the big idea?
Well, you're right that the stock market's done pretty well overall, and part of the reason it's done pretty well is because you've got millions of people who, through their combined analytical skills and buying and selling decisions, they're all working to determine the price of publicly traded companies. That's basically what the stock market does. And it's pretty good at it, and it tends to go up over time. But it's not a perfect system. Even those millions of investors can be wrong sometimes, and the existence of things like bubbles and stock market crashes are demonstrations of the fact that the market sometimes becomes detached from reality and gets things wrong. And in those situations, someone who goes against the herd and acts on a piece of information that other people don't know or other people haven't digested yet, that person can make a lot of money if they're right when the market is wrong. That's kind of the appeal of contrarian investing. If you want to make more than the market is making over a given period of time, you're gonna have to do something that the rest of the market is not doing.
So there are millions of people. Obviously, whatever you do, there's probably someone else doing the same thing. How do you know you're a contrarian?
Well, I think one good way to determine that is by looking at how specific your investment strategy is. If you're just buying and holding an S&P 500 index fund, that's probably not contrarian investing. If you're investing into a specific thing that you feel has been treated too harshly by the market, there's a good chance that what you're doing is contrarian investing.
Talk to me a little bit about what makes a good contrarian investor, how you do it with the most responsible mindset.
Yeah, so when we're talking about good contrarian investing, we're often talking about value investing, which is a discipline that's based around buying stocks that you feel are undervalued, that you feel are worth more than the stock market is pricing them. And this is a really time-tested discipline that has a lot of good things going for it. Warren Buffett, who's one of the most famous and successful investors of all time, his whole thing is value investing. And a thing about value investing that separates it from some of the more sketchy methods of investing is that it's very scientific. You make your thesis and you make it based on numerical evidence, and then you see how that thesis is playing out and you choose whether to stick with it or abandon it. So suppose you're looking at a soda company and you're looking at its earnings and its dividend and its net assets and its other kind of financial fundamentals. And suppose you notice that this soda company's price to earnings ratio is 20% lower than the average among other soda companies. You might say, well, I think that this soda company has very strong earnings, and there's not a particularly good reason why it's being priced less than its competitors as a ratio of earnings. So I'm going to buy this because I think that it's going to go up 20% in the next year so that it closes that PE gap. And if you do this and you buy the company and you're trying to be a responsible contrarian investor, you'll kind of monitor what the stock is doing. Maybe not every day, but every few weeks. And if it's moving in the direction you thought it would, you stick with it. Or if it starts going down, or if they have a really bad quarter where they don't sell much soda, you might decide that your thesis no longer holds and you might sell and abandon the investment. So the idea being that good contrarian investing, it's very metered, it's very scientific, it's based on hard data, and so you're still taking a risk, you're still betting that the market is wrong, but you at least have a specific case for why you think it's wrong.
Yeah, in the case of someone like Warren Buffett, even though he's a value investor, he takes a contrarian view sometimes, he's so well respected that when he makes one of these decisions, it actually changes how the market thinks about it. I mean, not everyone gets there. But I suppose one of the questions is, you're talking about having some humility here, right? I think it's like, I have an idea. Does it work? You're doing research to see if there's a reason that you're not finding. Then you make your investment decision. Then you watch it and try to make it, see if it adds up to the story you were telling yourself. I'm guessing that people who don't do contrarian investing as well are going to be the ones who are a little more sure of their thesis and maybe aren't open to information that might counteract it.
Yeah, so you really nailed it there in that bad contrarian investing is often based on a kind of black and white thinking where you're certain you're right, and it can kind of sometimes get into the area of conspiracy theory in a way. So most people are probably familiar with Reddit's investing community. It got pretty famous in 2021 for pumping up the price of GameStop, among other things. They tend to spin up these narratives about how there's a conspiracy of powerful investment banks and mainstream media institutions who are pushing down the prices of these companies for unstated reasons. You'll see a lot of kind of black and white thinking, sunk cost fallacy, where a lot of these people will stick with a losing investment long after it's proven itself to be a losing investment because they are just too wrapped up in this narrative that they've created. And a lot of people lose a lot of money this way because when you kind of get into that sunk cost mindset, you can end up throwing good money after bad, as they say. You can try to kind of salvage an investment that has lost you a lot of money by pouring more money into it, and you end up losing that money as well.
If you want to be a contrarian investor, it seems like, again, you're really going to be looking to come up with an idea and then test that idea. Can you talk a little bit about how you might do that?
Yeah, so there are a few metrics that contrarian investors, and specifically value investors, really like to look at. One of them, which I think I mentioned before, is price to earnings ratio. There's a whole bunch of different ratios that value investors use to try to determine whether a particular price for a particular company makes sense. PE, or price to earnings, is perhaps the best well known, in that that's just taking the company's earnings per share over the last 12 months and dividing the current share price by that number. And people used to say that there's a rule of thumb where good PE is around 20. I think that that's kind of outdated, and you're going to have to look at a specific industry and see what the average PE is like in order to evaluate a company in that industry. A low PE is generally an indication that a company is being valued lower than its peers relative to its earnings per share, whereas a high PE is generally an indication that a company is being valued very highly and might have a lot of hype around it, whether justified or not. Value investors also tend to look at dividend-paying companies, and specifically companies that pay dividends very reliably, that have a history of maintaining and increasing their dividend payout. And they also look pretty closely at the business itself, at what sales are like, what kind of track record the management has, what kind of competition there is. So these are all kind of solid data points that you can find on any number of financial websites. And it's a little bit of digging to put together this information, but it's all pretty publicly available information that anyone can find.
You told me earlier about Warren Buffett. Even he is willing to admit that he was wrong. You were telling me about Taiwan Semiconductor. Can you talk a little bit about kind of how a responsible contrarian or value investor might unwind investment they made that they felt didn't add up to what they had hoped?
Yeah, so Warren Buffett buying and then selling Taiwan Semiconductor Manufacturing is an interesting example because he actually didn't sell all of it. And it's worth noting that, contrarian investing aside, when you're buying and then selling stocks, you can kind of go a middle path if you're not sure if you want to completely exit a stock. You can sell half of it or most of it. And the reason this is relevant to Warren Buffett is because when he looked at his Taiwan Semiconductor investment a couple months after buying it and he wasn't pleased with it, he didn't dump the entire thing. He dumped the majority of it, but he did hold on to some shares. And so if you're kind of thinking that you might have erred with a particular investment, but you're not 100% sure and you want to hold on to some of your shares, that's always an option. You can always sell half or 3/4 of the position and then reassess later whether you want to hold on to the rest of it.
So it seems like if you want to get into contrarian investing, you've got to be ready to think about your portfolio more than you might otherwise if you were just buying funds and letting someone else manage them for you. Is that accurate?
Oh, definitely. And even the really responsible way of contrarian investing I just described, it's definitely risky. I mean, even the masters of it, like Warren Buffett, mess up sometimes and end up losing money on a trade. And yeah, it's definitely something that you have to be prepared to worry about a lot if you're going to go down this road, because it means actively buying and monitoring investments, which can be a real source of stress if you're not ready for it.
It's important to emphasize that no matter what kind of investing you're doing, you always want to do enough research to feel like you understand what you're buying. Say you're buying an index fund, a really broad selection of stocks that gives you exposure to a lot of different sectors of the economy. Even if you do that, you still want to know who's running this fund, what's the company, who's the manager, what's their experience, what are the fees. These are things you want to know and are going to affect how your investment could potentially turn out. When you're buying individual stocks, and particularly when you're trying to go against the market in general, you're going to want to step up that diligence to an even higher level because the risks are higher and the potential rewards are higher. So what does that mean? Essentially, you want to take the time to be confident that you've made the best decision you can. And if you feel like you made a good decision, no investment works out 100% of the time. Even if it doesn't work out, you can at least look back and say, I thought that through, and I feel good about the way that I thought about it. I'm Andy Rosen, an investing and taxes writer for NerdWallet. Thanks so much to Sam for being on the video. And Sam and my other colleagues have a ton of other stocks content on NerdWallet that you can check out by going to our website. If you learned something today, please like and subscribe.